Thank you for all coming out. It's an awesome turnout. Welcome to the 2023 Forecast Symposium powered by CFA Society Indianapolis. It's awesome to see everyone back here. I remember 3 years ago when we brought this event here and did it big time for a big nightly event. We had 110 people. It was a great night of education and networking, and it shut down the world almost literally with COVID hitting that next month. But we're really awesome and glad to see this coming back, and everyone that's supporting the society and the movement that we're doing, the team that we're putting on. It's really just great to see, and we look forward to kind of keep putting this on. And with that said, we want to highlight all the people that really make these events happen, because it's not one person, it's not two people, it's not paid support, it's everybody. So if you're a part of the CFA board team, and Tom and Allison, if you guys could all please stand. Can we give all these people a huge round of applause? I'm extremely proud of the team that we have and all the stuff that we're doing right now. We've got events lined up for the next 5 months leading up to our big annual event, the Investment Forum at the Speedway. As many of you know, we launched that last year, had 250 people, had all kinds of incredible speakers from the governor, Jim Bianco, along the lines, and we're coming back and going to do that big again this year. So hopefully you guys keep that on your calendar, keep us in your minds, get on our newsletter. We want to have you out, we want to educate you, we want to network you with other people, and it's just going to be awesome. So I'm going to turn it over to Ted. And Ted is the guy that put most of this on and did all the behind the scenes and got everyone here. So let's give him a huge round of applause.
All right, not to start a bromance, but this is also a Jared Luger's appreciation minute. As a president of a chapter like Indianapolis, he puts a lot of volunteer time into making this thing run. Our board is probably more of an unruly mob, so he has to deal with us as well, which doesn't really make it any easier. And he really wants this society to punch above its weight. So with events like tonight, the RIAs and alternatives in February, and the investment forum in May, you're definitely doing that, Jared, so thank you. I also wanted to give another thank you to our marketing director, Allison. She does a lot of work with us as well, and we really appreciate it. And our executive director, Tom Heck. So thank you, both of you. Next, I'd like to thank all the friendly faces that made it out tonight. Definitely means a lot to me that so many of you came out to support the event, and we really appreciate it. And then lastly, I'd like to thank Andrew Renz. Could you stand up, Andrew? All right, Andrew is the one that asked Jim back in September if we could have Cliff come on. So we definitely appreciate you doing that, Andrew. And Cliff, if you hate this, blame him. Blame Andrew. All right, so enough with the pleasantries. So before we get into 2023, I'm going to cause a lot of people heartburn and talk about 2022, except for Cliff and AQR. They would love to talk about 22 all night. All right, so I know a lot of you have heard all the statistics about the worst since for 2022. Setting the stage a little bit, 2022 was the 7th worst year over the last 100 years for the S&P 500. 2022 was a 3 standard deviation move for the bond markets, or a 1 in 370 year event, if you assume the global ag is normally distributed. Obviously, it probably isn't, so if you want to come talk about it, please find me upstairs later. Next, 60/40 portfolio had its 2nd worst year since the 1930s. And then last, bonds and stocks trailing 2-year correlation became the most correlated since the 1990s. Obviously, a tough year for a diversified portfolio. So, as portfolio managers and asset allocators, what are we going to do about it? Well, that's why we brought our speakers in tonight. We'll hear from Cliff later as he talks about uncorrelated return streams. But first, we'll hear from our local speaker, Andrew Thrasher. Andrew is a Purdue grad and local portfolio manager for the Financial Enhancement Group. He's also the founder of Thrasher Analytics, a weekly service dedicated to analyzing the markets. He has an award-winning paper called Forecasting a Volatility Tsunami, which he'll be using tonight as he talks through his forecasts and what he sees in the market in the current time. He recently was a finalist for the Best Equity Research and Commodity Research for Technical Analysis in 2022. His work has been cited on CNBC, Bloomberg, Barron's, Fox Business, MarketWatch, Wall Street Journal, and Reuters. So please, welcome to the stage Andrew Thrasher to kick off the Forecast Symposium.
Thank you so much. It's an honor to be here before you. I am not a CFA. I am a chartered market technician. I have a lot of charts to share with you, so hopefully you can see the screen. And he went through my first slide, so we're already halfway there almost. Like I said, I graduated from Purdue. I'm a portfolio manager. I'm here to talk to you about the paper that I wrote that won the Charles Dow Award in 2017 called Forecasting a Volatility Tsunami. But first, I'm a technician. I look at charts, I look at price action, supply demand. I spend the entire day looking and analyzing the market from a chart perspective, so you can trust me, just as this chart shows. So again, I'm here to talk about my paper, Forecasting a Volatility Tsunami. I talked fairly quickly. I'll be trying to go through these slides, so hopefully you can bear with me. As a portfolio manager, my main responsibility, and something you all can probably relate to, is risk management is my number one focus, my number one priority. We work primarily with those planning for retirement, and so trying to make that path to their ultimate goals and their own financial journey as easy and as smooth as possible is our biggest objective and biggest goal. To do that, we're constantly looking at different ways to evaluate the market, different ways to add tools to our toolbox for risk management. And that's what led to the genesis and to the creation of the paper that I wrote. And the first step is we must analyze and say, is it really worth being active in the financial markets? The biggest argument, or one of the largest arguments against active management is, well, you're going to give up all that exposure to the best days in the market. And that's true, you would. But you would also be, if you're trying to avoid some of the worst days of the market, it still produces a positive outcome. This chart, I think, does a better job of showing that. If we were to miss both the best 25 days in the market and also miss the 25 worst, from 1950 through 2006, this was from when I wrote the paper, we still had a positive outcome versus just buy and hold during that entire time period. I'm not going to spend the entire time arguing the benefits and the negatives to active management, but we do believe and take that philosophy that active management can produce fruit and is an opportune way to manage assets. So one of the tools, like I said, we're constantly looking for ways to measure risk and to evaluate the amount of risk we want to take within a portfolio. And one of the tools we use is the VIX. The VIX is the volatility index, looking at the amount of wiggles the S&P 500 is going to do over the next 30 days, essentially. We're not going to get too far into the math there, but it's looking at the expected volatility for the equity market. Traditionally, volatility is negatively correlated to the S&P 500. It doesn't have a perfect negative correlation, but it traditionally will see those big spikes when the equity market is beginning to decline. And that's, as a portfolio manager, what I really wanted to focus on was those spikes in volatility. And so for my paper, I had to first define what was a volatility spike. And so for anyone that does look at VIX, I know this is the cardinal sin. I'm quoting the VIX in percentage terms, but to standardize it for the paper, that's what I really kind of needed to do. So I define a spike in volatility as a 30% increase over 3 days. We've had enough of those to give me a large enough sample size, but it's not something that happens every day. So traditionally, if the VIX spikes at 30% in 3 days, I quantify that as a good spike, and that's what I wanted to really try to focus on with this paper. And so as I started looking at different opportunities, different ways to what precedes these spikes in volatility, the first one I looked at was, what about large drops in the VIX? Since traditionally the equity market sees its returns clustered, some of the best days and worst days are often very close to each other, do we see the same with volatility? And the answer was no. Large drops in volatility was not a great predictor of when we'd have these big spikes higher. But then we found what the press is obsessed with. We constantly hear, if you turn on any financial news publication, we hear about low volatility. The VIX is really low, low volatility, low volatility, low volatility. Was this a good barometer for predicting what the financial press would tell you to be a very scary time? The VIX is really low. We need to be afraid of the market. And the answer is no. The VIX being extremely low wasn't by itself a great predictor of these spikes. So I looked and found every time the VIX hit a new 4-week low, what happened next? And as you can see from the plethora of red dots here, just because the VIX was hitting a 4-week low really didn't have a lot of value in trying to forecast these big spikes, these 30% increases in volatility. So looking at it from a more quantitatively lens, when we look at a scatter plot of the 3-week change in volatility based off where the starting value of the VIX was, basically the biggest spikes in volatility occurred when the spot VIX was between 10 and 40. Well, that's a really large range to say if just because the VIX is 38, again, doesn't give me a lot of value as a risk manager and as a portfolio manager. And so we need to continue to look for better opportunities. That's what led me to start looking at dispersion, specifically just a fancy way of standard deviation. And so what I found is when standard deviation was very, very low, had contracted, this was a very common characteristic to precede these spikes in volatility. You can see that by the scatter plot, some of the biggest spikes we've had have occurred right after standard deviation became very, very compressed. And so here's, again, just the VIX and the standard deviation. And we're going to look at a lot more specific examples, but here's a long-term look, just at a simple 20-day standard deviation for the VIX, trying to keep it very, very simple. The belief is that when the VIX is extremely calm or we're not seeing these big moves, that it must mean the market's stable. And I think this is important because I think volatility is an excellent gauge of investor sentiment. I think when the VIX is very calm, it's telling us that there's a degree of overconfidence in the equity market. And this lack of volatility is telling us that overconfidence could breed instability. The famous quote, "Stability can breed instability," I think applies very much to the VIX and to volatility. And so in my paper, I produced this table that found that when we see volatility compress based off standard deviation, we see on average the returns, not necessarily the returns, but the change in the VIX was very, very large. Over the next 3 weeks, on average, it went up over 30%, compared to the entire sample size of VIX only really rising about 25% on average over a 3-week period. We also found that the volatility doesn't really go down a lot more, providing a good opportunity for potential hedging strategies. That VIX traditionally does create a durable bottom after you see these very tight compressions in standard deviations, seeing much lower, less downside than traditionally any other time period for the VIX. So again, in the paper I looked at for the top 10% readings for standard deviations, which gave me 0.86. We use a different measure now within our firm of how we evaluate standard deviation. But for the paper, I was looking at any time volatility standard deviation got really, really low, and then I plotted a pretty red dot to visually represent that. And we're going to zoom in on several of these to really show the impactfulness of using standard deviation on the VIX. What's important to remember is that while standard deviation, when it does compress, is not a signal of itself that's going to always lead to a spike in volatility, but very rarely have we ever seen the volatility spike that was not preceded by this condition being met. Actually, looking at some of the data where they tried to recreate what the VIX would have looked like on Black Monday, Cliff could probably talk more to that. I was not born yet. But what the VIX did during that time, we actually do, from the recreation of that data, and it's a little bit questionable, but we do see it did compress similar to what the VIX we have now. So even the fake VIX compressed before Black Monday, and we saw it during the dot-com period, and we saw it during the COVID crash. We're going to look at that example here shortly. But the main point here is this creates an environment that we're able to use as risk managers to where it's potential that we could start seeing some downside in the equity market. And so that's exactly how we use it. Just because the clouds outside maybe start to get really dark, or as tonight they're going to start getting dark because of snow, doesn't actually mean you're going to cancel your plans and stay inside. What it means is that we probably want to start carrying an umbrella before we go out to be prepared. And that's how we evaluate, that's how we use this as a tool. It's an identification of an environment that volatility is ripe to potentially create a spike. Just like the clouds getting dark is a condition that we could have a really bad storm. So we want to be prepared for that type of environment. So looking at a few different examples, as a technician, I'm not concerned at all with what causes volatility to go higher or with the equity market to go lower. I don't care if it's earnings, if it's China, if it's a Trump tweet, if it's a Biden whatever, if it's a worldwide pandemic. All I care about is the changes within the market. And so some of these different examples where we saw volatility compress, we had a minor increase and another minor increase, and then something happened, I believe this one was China, where VIX did go from 12 to 53, but this again was preceded by that really tight compression in standard deviation. Let's fast forward to 2018. Again, ironically, I wrote this paper in 2016. I won the Dow Award in 2017. And for those of you that were in the markets, probably most of you in 2017, least volatile year we've ever had. Great time to write a paper on volatility. But during that time period, we did see a lot of periods creating that environment where volatility was ripe to spike. And the first several, plotting again, pretty red dots of when it first began to compress, the first two were very minor increases in volatility. And then we had Volmageddon occur in February of 2018, which for the last 3 months, we were seeing that really tight compression. We weren't trying to forecast that what VIX was going to do or that products like HXIV were going to collapse. We didn't know that was going to happen, but we did know that the roadblocks the groundwork had been set for these spikes to occur. What about a global pandemic? Again, we had a minor increase in 2019, and then again in January of 2020, we again saw volatility compress. The world got COVID and VIX went to 80. Again, we didn't need to be epidemiologists. We didn't need to know what Fauci was going to do. All we need to know was that volatility was creating this opportunity, this environment for volatility to spike higher, allowing us to use this as a tool with, among other tools, to manage risk on behalf of our clients. And so the final point I want to make is, does volatility spike from major lows? So we talked about it first, looking at 4-week lows. What I'm going to look at next, and this is a busy chart, I'm going to walk you through it. I know you're CFAs, I'll try to talk slowly. But looking at 6-month lows, we very rarely see volatility spike. And so we can use that information as portfolio managers and managers of risk, is that when the VIX hits a 6-month low, it very rarely then leads to one of these spikes higher. So I've plotted a pretty blue dot this time for every time the VIX hit a 6-month low, and put again on top of that our definition of a spike being a 30% increase. And so when we combine all these together to create a composite, we can see traditionally, historically, the VIX bottoms roughly about 11 days on average before we see a spike higher. So traditionally, 2 weeks we'll see a low, and VIX will slowly start to build up higher before it has kind of that release, as if you're holding like a ball underwater and then let it go and it shoots up higher. We see that kind of slow build. Traditionally takes about 2 weeks. So again, if we look at that same chart of when VIX hit 6-month lows, how many of these were the exceptions that prove the rule? How many times did we actually see volatility spike from a 6-month low? Just a couple. And it's very interesting when we do look at this that there were really only 5 times did we see the VIX spike in less than 2 weeks of a 6-month low. But what's interesting about them is if we look at them individually, they were almost like small tremors of volatility that preceded much larger volatility spikes. Ones that as a portfolio manager, these are the ones I'm most wanting to be aware of. And so these minor increases in volatility happened just before we saw much larger increase in volatility, as again, because volatility traditionally begins that slow build moving higher from those 6-month lows before we really see kind of that massive spike that's going to get a lot of attention. And before those spikes, again, as you can see on the red arrows on the bottom, one that got a little bit funky, we did see standard deviation get compressed before all those as well. So where are we today? The question everyone's probably asking. And right now, the last year, we really didn't see a lot of volatility. As much as the equity markets, like he said, they're the 7th worst year since Adam and Eve. I don't know how as far back as we want to go, the Civil War. We really didn't see a lot of volatility in 2020. The volatility was much more on the bond side. If you watch the MOVE index, the volatility of the bond market, that's where a lot of the volatile action was occurring. So we didn't see a lot of compression occur in 2020. We did actually last week. We did begin to see compression in standard deviation last week, and we also hit a 6-month low. So as a portfolio manager, as a risk manager, that tells me that we're starting to see potentially a low in spot volatility and begin to see maybe a slow grind higher. What will be the ultimate cause of it? I don't know, and nor do I care. Is it FOMC next week? Very well could be. But I do recognize that from a sentiment perspective for equities, based off what volatility is telling us, that the market's gotten a little overconfident, that volatility is no longer seeing these big gyrations, and that compression creates the environment for the VIX to move higher. And so we can then use that within our process as a firm. So just finally, in conclusion, narrowing of dispersion and volatility has been a great predictor of heightened risk and spikes in the VIX. Very rarely have we ever seen the VIX spike that was not preceded by this condition. So it's something that's very much worth monitoring, as well as recognizing that we don't see VIX spike from major lows. It traditionally has that slow build, like I said, roughly 11 days historically. Doesn't necessarily mean it's always going to be 11 days, but traditionally we do see that slow move higher in volatility, and this is something we're constantly monitoring as portfolio managers to be aware of with how we're taking that risk within our portfolios. So if you do have an interest in reading the paper, would happy for you to, you're welcome to download it. If you just search forecast and volatility tsunami, there's not a lot of other things titled that. It's available for free on SSRN. It's been downloaded over 10,000 times. One of the top 10% of most read papers in their database, which is a great honor for me, and very appreciate that. If you want to find me, I'm on Twitter. I have a public blog where I write about technical analysis, and then managing money for a financial enhancement group, and I also write research, institutional level research on technical analysis and different modeling, including the VIX at Thresher Analytics. So I know you're all here to see Cliff Asness. I'm very much look forward to hearing him talk as well. He's an amazing, I describe him as kind of be on the Mount Rushmore of Wall Street. He really wanted me not to set the bar too high, so I hope that doesn't do it, Cliff. But I appreciate your time. I hope you found this interesting. It was a great honor to come speak to you as a non-CFA charter holder, and it's a great honor. So thank you very much, and I hope to talk with some of you guys in the after when we go to the suite to watch the game. Thank you.
Thank you, Andrew. Appreciate it. And we actually read kind of fast, so. All right, real quick while we do a scene change up here. We wanted to thank all of our sponsors. So Lazard, Proteus, CBRE, Adipar, John Hancock, SCI, Invesco, and Winthrop. Thank you for sponsoring this event. We appreciate it. And we hope to see you out at future events. So give us 1 second here, and we will welcome Cliff to the stage. We are. All right, second act, let's go. All right, Cliff. Thank you for
Hello,
joining
everyone.
us.
Really made up for that ageist comment at the end with the compliments. Though Mount Rushmore has an age element to it also. Though you're not wrong. I was 21 and working part-time for Payne Weber in 1987 when the stock market crashed. So, little bit rude, but not wrong.
All right, well, thank you for joining us. Sure. We'll start off with an easy one. All right, if you think back to what motivated you and the co-founders to start AQR and how much evolution the investment world has seen over the last 25 years, do those original drivers still motivate you?
What motivated us to start AQR? Am I allowed to mention greed?
Yes.
Well, anyone who starts a financial firm that started with a hedge fund product who didn't do it partly because they thought they could do very well if it went well is simply not telling the truth. Though the original idea behind AQR is still very much the idea now. It's to take basic research, both that originating in academia and our own, because a lot of us were former academics or almost academics, and see if we can make actual money for clients with it. And not all research translates to this will shock no one in the room who's taken a CFA exam, but not all research translates. Some of it is simply wrong. It was data mining. Some of it is right, but doesn't overcome costs. Some of it is right and overcomes costs, but is already being done by something else. So you really just like rename a lot of research. You find you're really renaming something someone else did. So that was the goal then. Research has moved on. We've certainly grown what we do, and we've changed some things over time. But the general idea to see if basic research, I mean, AQR, I sometimes let people think this, but they often think I'm the A in AQR. No, it stands for Applied Quantitative Research. When we were at Goldman Sachs and there was a little group of us thinking about starting our own firm, we had about 7 meetings saying, should we do this? We're happy here, but everyone deteriorated into what would we name this firm if we did start it? And we considered every name in the world of mythological creatures and jungle beasts, and we came up with the IBM of names. It suits us well because it's exactly what we do, which is partly why I love the name, and it lets a lot of people look for a Q and an R.
AQR has a pretty wide range of asset classes and strategies. In your mind, what do they have in common? What does AQR stand for when it comes to investing?
Applied quantitative research. I just answered that. Now, on the one hand, I know it looks like we trade everything. And in the liquid world, we really do. From individual stocks to stock indices, country bond markets, commodities, you name it. We actually do much, much less than it looks like. We are really taking the same general ideas and repeating them over and over again. What are these general ideas? Again, as with the exception of Mr. Thrasher, as a room full of CFA holders, he seems very proud not to have one. I don't have one. The basic things out there, do cheap things tend to beat expensive things? Do things with good, both price and fundamental momentum, tend to beat their poor counterparts? Do higher quality, both more profitable and lower risk firms, tend to beat their lower quality alternatives? Well, I think yes. That's not all we do. The world has moved on. There are some additional things, some I'll talk about, some I won't talk about, but those are still very core concepts. And we kind of lucked into this. The first thing we were asked to do at Goldman Sachs, they asked me to start a quantitative research group. I said, sure, I'd love to do that. We had no actual mandate. They let me hire 3 people, so we were a 4-person group. And then we were looking around Goldman Asset Management saying, okay, what do you guys actually want us to do? Nobody had any idea. They just knew that a lot of firms were building up quantitative capacity, and I was working there in fixed income, actually, while writing my dissertation at night on quantitative equities. So they're like, we got a guy, you should start it. So we kind of we were door-to-door quants going around Goldman Sachs saying, does anyone need something? And the first job they asked us to do was to see if we could help the equity teams, the active on-the-ground equity teams, choose what countries to be in and what countries to avoid. The reason they asked us to do this is the same terrible reason every big organization makes a decision, because that part of the active process had not gone well for the prior few years. I always felt guilty about that because I kind of knew that probably wasn't a very statistically valid result, but I needed a job. So when they said, could you guys help pick countries? We said, of course we can help pick countries. Then we went in a room that was about 8 by 8, sat around and said, how are we going to pick countries? Very quickly, actually embarrassingly slowly, took about half a day. So I don't know, that's quick to come up with something new, but embarrassing because it's so obvious. We said, well, countries are just portfolios of individual stocks. The main results in academia at that time were value and momentum and size. We were never big size traders, and we said, let's see if that works for countries. Let's treat countries like they're individual stocks. What's the PE of France and Germany? If Germany's PE is much higher, people are very optimistic about it, and perhaps they're going to get lower returns going forward. Momentum is even easier. Buy what's going up and sell what's going down. We wrote a paper in the Journal of Portfolio Management, a very long-winded pseudo-academic title. We were still trying to be academics at that point. It was the parallels between the expected cross-section of stock and country returns. saying, hey, the same stuff holds up. And then we just kind of rolled through the world. We went to global bond markets to compare countries. And at that point said, well, what would value and momentum mean in a bond market? Momentum, there are a lot of other forms besides just price momentum, but you always get to start with that. So that's always an easy one. The first thing you test is that. But for value, it was things like, it's very simple things, real bond yield, slope of a yield curve for the carry effect. And we said, hey, you get pretty similar risk-adjusted returns with bonds. And then we went through one after the other. And the same thing occurred as we added other things to what we do. So it looks like we do a whole bunch of things. We do the same thing in many places and are blessed that it's not very correlated in these different places. The other thing that's a real common reoccurring theme is we are kind of nuts about diversification. Risk parity is one of the more obvious ones where you want to allocate, at least in our view, by risk, not by dollars. But even in other processes we do. If there are two strategies that have a similar risk-adjusted return and one is extremely volatile, give it less dollars. We're trying to equilibrate these things. I'll give you a current example. In our trend following, particularly we run a more off-the-run trend following product that trades a little more esoteric securities. It's the only place we trade crypto because the only thing we know about crypto is what the price has done. I'm not saying other people don't understand crypto. I'm saying, again, I'm a little too old. Crypto is something for younger people. But price trend holds up. It holds up. But you have to do very small notional positions in crypto because, not to get technical after the VIX presentation, but crypto is freaking scary. But that's about balancing and doing things by risk, and that's where you get diversification if you let one thing dominate. So those two principles, what are the basic factors that repeat? Value, momentum, profitability, low risk investing, carry, trend, and then leaning really hard into, are we really diversified as much as we can? That's all we do, and we just do it over and over and over again.
I was going to add, I'm also not a CFA, and this probably explains why.
Is anyone here a CFA?
This explains why passive investment is taken off. They just don't actually want to do anything. All right, moving on a little bit. Expected return environment. So the silver lining of the bond sell-off is we now actually have yield again on bonds. Before 2022, you had written that the traditional multi-asset portfolio is in a tough spot. With rates up, do we still think there's a disappointing decade ahead? What do you kind of think of from what's available for a portfolio?
It's a great question. First of all, you get too much blame in this industry when you're wrong for a while and too much credit when you're right for a while. We have been talking about a low expected return environment on traditional assets for a pretty decent amount of time before 2022. So I don't want to claim like we walked in before 2022 and said, get out now. That's not what happened. At AQR, and particularly through the work of one of my colleagues, Antti Ilmanen, I only had one beer, and I nailed his name. I've only known Antti for 32 years, but sometimes I mangle it. He's the main guy at our firm who does this. We really do it just to start dialogues with our clients. We don't really trade on 10-year forecasts. But if you're making a 10-year forecast, you don't have much to go on aside from starting valuation. The current state of technicals might be really interesting. It's not interesting on a 10-year horizon. Forecasting specific growth opportunities. No. If you buy expensive things, the expected return over 10 years is lower than normal. Doesn't have to be a disaster, but lower than normal, and vice versa. And going into 2022, the expected return on the 60/40 portfolio was the lowest we'd ever seen. And this is not from weird esoteric stuff. This is stuff like looking at Schiller tapes, flipping them over, and that's a form of expected real return on equity. It's not a perfect measure by any means, but it gets the direction right. Expected real bond return, which is not more complicated than looking at the current 10-year yield, subtracting out economist forecasts of inflation. Historically, 60-40 has made probably, call it 4.5% over inflation. So maybe 7-8% nominal. Obviously, stocks have done better. Bonds have done less. Going into 2022, instead of the 4.5% historical average, it was about 2. Now, what to do with that? Again, we're not real market timers. We were talking about it for a while, and it just kept getting more expensive. But we stick with our long-term forecast. With the big trade-off, and the numbers were summarized accurately, it was probably about a 3 standard deviation year. I do agree that 3 standard deviations is not what it's cracked up to be. We see them all the time in our field. You got to get up to about 5 for me to really start getting impressed, for good or for bad. But going in, lowest forecast ever. By the way, this came from both stocks and bonds. We have seen considerably worse, higher valuations, lower forward-looking returns on equities, in particular, in the tech bubble, which some of you have to be old enough to have been doing this during the tech bubble. 87's pushing it, I know, but the tech bubble, we had just started AQR before it. We saw the Schiller Cape get to about 45. It got to the mid-30s this time. That last 10 will really kill you. So it was non-trivially more expensive and lower expected return. Bonds were about as bad as they've been historically, but not way worse. We've seen other periods of minor negative expected real yields on bonds. What we really hadn't seen is both be really bad at the same time. That's how you get the expected return on 60-40 to be that anomalously low. What to do with that? I want to be careful. Again, we don't tell people to market time based on this. The 4.5% that was made on 60-40 over the last 100 to plus years may have been too much. I know it's never too much. We all want more, but it may have been more than an investor should require. One way to think about it is I can quote this 4.5 from the same data we can all pull down, but very few people actually made that. Right? Stocks were much more expensive to trade, and even those who made it, the average investor owned a very concentrated portfolio. The idea of a diversified index wasn't there. So they were looking probably about double the volatility on stocks that we would think about. So perhaps they demanded a higher top-line return. So it's really hard to say what is impossible going forward. But when you see 2, here's what you're not allowed to do. I say not allowed. We don't think you should do. Is say, well, we don't know if it's going to crash, so we're still going to stay invested and still use the 4.5% number to forecast going forward. You got to actually use the 2. You don't have to forecast doom to come. And your number might not be precisely the same as our number. So last year, we saw this big trade-off, and it was fairly massive. And it took that number from, call it 2 to 3, maybe the low 3s. From here, again, I would not look at history, plug that in going forward, and say we're going to make 4.5% over inflation going forward. I believe the number will be more like 3, which is what it says now. But this is very subjective. Again, no one can prove what we really should require, but I will tell you 2 felt a little low. 3 versus 4.5 historically, we actually can have the option at least to really receive the 3 because you have low-cost diversified investing. This could be, I hate using the term new normal. It's such a cliche, but it could be the new normal. I didn't think 2 could be. But again, I didn't go run out and tell people to short the ranch. Do you short the ranch? You buy the farm. You bet the ranch. No, you don't short the ranch. Going forward, I'd still use a decently lower number than history. Though a year and change ago, I might have been inclined, if really pushed, to go, yeah, own a little less now. I'm less inclined to do that. I'm more inclined to be agnostic about whether this is going to change a lot. It's just, assuming you get the last 100 years again, I think it's just too rosy.
So moving on to other asset classes, obviously AQR in your book would have been very helpful last year with its diversified return stream. Besides the attractive returns, Many hedge funds claim to provide significant diversification, returns not associated with stocks and bonds for traditional portfolios. Your analysis has shown that hedge funds in aggregate have significantly more market exposure than simple estimates indicate. Given this, how should investors think about benchmarking their hedge fund managers?
We're going back to a paper that I wrote with colleagues in the year 2000. It's called Do Hedge Funds Hedge? If anyone writes a paper with that title, they're going to tell you not as much as you think. You know what the answer is going to be just from the title. We did a few things. We took the known indices of hedge funds. They have gigantic flaws. Anyone looking at this who knows hedge funds, the first thing you say is, for instance, AQR doesn't report to these indices. So certainly they're not fully inclusive, but they are the best we got. And they are often the same ones that were used for very positive comments on the hedge fund world. We did two things. First, which is still a theme of ours, is we adjusted for illiquidity. It turned out a lot of people ran tests on the reported hedge fund returns, which, and I don't know if we'll get to privates today, which some people may know is a little bit of an issue for me. And I wasn't even close to this at this point. But a lot of hedge funds will own some degree of illiquid assets, not as extreme as true privates. So their volatility looks dampened. If you look at a hedge fund beta, and again, it's a CFA I can talk this way, and run a regression on the market, you get like a 0.3 beta. If you adjust for this illiquidity, you get about a 0.5 beta. And the geeky way you adjust is you say the market, hedge funds don't just move as a function of this month's market return, but the prior few, meaning it trickles in to the prices, and then you can estimate it. We also found the alpha was quite trivial after adjusting for this. Now, I want to be careful. We run things you could call a hedge fund. I didn't think these results meant it can't be done, that you can't create low correlation assets that have positive alpha. It just said that the industry as a whole was not doing it. But as to benchmarks, if I had to come up with a benchmark for the whole hedge fund industry, I would definitely, history has actually really borne this out. The next 20 plus years after our paper have looked a lot like the sample. The paper sample size was like 7 years. I'm making a lot of comments about how old I am. But when you have 3 times the out of sample evidence that you had when you wrote a paper, that's not a normal situation. So if I was saying, did hedge funds have a good year? And I was actually thinking of updating this for last year, because I think hedge funds had one of their first decently outperforming their beta years in a while last year. I would use that 0.5. For any individual manager, you really have to roll up your sleeves and say, I mean, there are, to use a 0.5 beta with us, I truly believe we're as short as we are long. So you'd mostly be saying we're really smart when the market goes down and really dumb when the market goes up. There are some hedge fund managers that are loaded up on all growth stocks who probably had a beta north of 1. So you do have to think about it, but I would not, to be blunt, I wouldn't let people benchmark themselves against absolute return if they run a steady positive beta. That's about it. Made me very popular in the hedge fund industry in 2000. I joked, I wrote something in 2000 about the definition of a hedge fund is a pool of capital that doesn't really tell you what it's doing, that charges a ton, and is run for rich people in Geneva, Switzerland, by rich people in Greenwich, Connecticut. 4 years later, I moved to Greenwich, Connecticut, which...
So you were successful?
I don't know. But I'm trying to replicate what I did with hedge funds with private equity, because you really do get some looks when you write cynical things about the industry. You go to your son's varsity hockey game, and there's another father or mother going, "You wrote that thing, didn't you?" It's like, yes, I did.
We'll definitely get to the volatility laundering at some point, but I wanted to quickly go over, well, not quickly, because this is probably your bread and butter, value investing. You've expressed in many ways your views about the value opportunity in stocks. It's been a good call for the last 12 months, but also a very bumpy ride. What do you think is driving the value rebound and its volatility? Is there a catalyst? And how long do you think it'll take for the relationship of cheap versus expensive stocks to get more reasonable levels?
It's going to take a while because you had 11 questions in there. No, it's good. It's good stuff. First, I want to back up a little bit and say when a quant talks about value, it drives kind of Graham and Dodd stock pickers crazy. Because the quote quant value factor, the academic value factor, is almost always just price divided by some fundamental. It's a multiple. True value is more holistic than that. The active, the Graham and Dodd type guys are not wrong, right? There are some things that deserve to be paid more for. There was a huge miscommunication for many years. I've actually tried. I'm usually one to throw gasoline on a fire. In this case, I really have tried to throw water on this one and make peace between these groups, because I think they come at it very different ways. But quants don't just believe in the value factor. They're looking for quality, low risk. These are the same things a more traditional Graham and Dodd type stock picker will look at as a whole, saying whether something is attractive, cheap in a broader sense. But for quants and academics, it really is the low multiple, the beaten up stocks, those stocks people are pessimistic about, is one of the major factors in the quant universe. It was bad since the GFC up until about the end of 2020. By the way, value has been rallying for a little over 2 years. Everyone focuses on last year. It's been pretty good. But the first 7 or 8 years of that, let's call it 2009 through 17, didn't really hurt Graham and Dodd managers, maybe some who were deep value. Certainly didn't hurt us. It was a very good period for us. We do not need value to go up to be happy. I wrote a piece recently, it's on our website, called "We Are Not Just Value Investors," and then in parentheses, except occasionally when we are. Because if you go through long periods, and I think 09 through 17 was kind of like this. Value can lose if it loses for what I'll call rational reasons, because the low multiple companies really didn't execute well going forward. They actually executed even below what was priced in. Value loses. Turns out that's not so terrible if you have other things in your process besides value. If you're looking for quality, fundamental, price momentum, low risk investing, those all thrived from 09 through 17. 18 through 20, I think, I don't like to use the word bubble too often, particularly when I'm within a few hundred miles of Gene Fama. I get nervous in the Midwest. He could walk in any second. I will use the word occasionally. I think I've seen 2 in my life. The tech bubble, at least for the stock stuff we trade, the tech bubble and certainly by 2020. But from 18 to 20, value stocks did not underperform on the fundamentals. They actually had executed well. We just saw multiples explode on growth versus value. In late 2019, I wrote a piece saying, Antti Ilmanen and I have written that timing factors and timing the market is something we call an investing sin. You can mess yourself up often more than you benefit. And then we tell people, get a little naughty look on our face and tell people, and we recommend you sin a little. And more accurately, sin a little and rarely. When prices get to gigantic unsustainable extremes, we think it is okay to have somewhat of a tilt. So in late 2019, I wrote a piece saying it's time for a venial value sin, meaning let's have a little more value than normal. I then wrote a piece about 5 months later, kind of sad, saying no sin has ever been punished this quickly and this violently. I don't actually know that's true. I've not done a full study of historical sin, but we ran into something. And, it's always, when you talk about events, it always sounds a little excuse-making, whining. I think COVID was a pretty good excuse. COVID is what took these already very, very big dispersion between cheap and expensive. And we've been tracking this since 1999. How cheap is cheap? You can always sort stocks by multiples, but sometimes they're actually not that different from each other, and sometimes they're gigantically different from each other. The end of 2019, they were gigantically different, but not wider than what we saw in the tech bubble. COVID sent the whole thing to well north of the tech bubble. Something I freely admit I never thought I'd see in my career. Again, talk about the normal distribution. I did think the tech bubble was the 1 in 50, 1 in 100 year kind of event. I would have said somebody will see it one day, but it won't be me. Too many people remember what happened. No, well, it was pretty bad before the pandemic, and then the pandemic, as I'm sure we all recall, made the market for about a year think all you needed to own was Peloton and Tesla. And that was a diversified portfolio. I mean, you own 2 stocks, and they do totally different things. One moves, the other just stays right there as you pedal. We stuck with it. We said it's even better now. We even allocated a little more to it. We do think when that spread gets very wide, it has, call it a 3 to 5 year strong predictive power. It does not have a 1 year super strong predictive power, as I proved in 2019. When I wasn't actually that early for these things, but I was called probably a year too early. Still think I would have nailed it if not for COVID, but it's the last time I'll mention that. A lot of people know COVID was a tragedy, but they don't really understand how it affected me. I don't mean to make light of that. I'm making fun of myself there. The catalyst question is always the hardest one. I am, first of all, a fan of when you get to what I'll call ridiculous pricing levels, a 45 Shiller Cape on the whole stock market in March of 2000, a value spread that was epically wider between cheap and expensive than we've ever seen before in, call it the fourth quarter of 2020. I think things tend to be a really good medium-term bet without knowing the catalysts. If you get a bad catalyst, whatever that may be, you will lose something, but I think a lot less than you'll make on a good catalyst when the pricing is so asymmetric. But the actual catalyst, you mentioned interest rates. That is probably the prime candidate. It's one I'm very conflicted on because the evidence is very mixed. For one, value started recovering in late 2020. It wasn't for at least a year before bonds really started to trade off. So value did start to recover without that big interest rate catalyst. Second, and we've written on this, in theory, we don't think interest rates should be so related to this. I'm sure you all know the story. Expensive stocks are expected to grow more. Therefore, their cash flows are further in the future. Therefore, they're like a long duration bond. Therefore, when discount rates or interest rates come down, they should rally more. It's a good story. It turns out, at least for a diversified global portfolio, any single Tesla will or will not grow like a crazy thing. But a diversified portfolio of many hundreds of cheap versus expensive stocks don't actually grow that differently. So the story doesn't really hold that well. Second, if you look empirically, just draw this chart. The x-axis, put the 1 year change in your favorite interest rate. On the y-axis, put growth versus value. There's no relationship going back about 50 years. In the last 5 years, there has been a relationship in the direction people would hypothesize. When interest rates have gone up, it's been better for value and vice versa. I think occasionally a story captures the market that is plausible sounding, and it is in your best interest to believe that story for tomorrow, because whatever has been going on will probably keep going on a little bit more. It is not in your best interest to avoid big. I tell tons of people, if this is what you're worried about with value, that it's really an interest rate bet. First of all, I don't think it is historically, as I just said. But if it only really is a bad thing if you have a very strong view that interest rates are going to rally a lot, right? If you're agnostic on this, it's actually a good thing to be short bonds. You're hedging one of the major asset classes out there. You have your normal expected return. So I don't know why even I get very defensive about this, but it's not a good story for a group like this because you like quick 3-sentence stories to explain things. We don't think they should be that related. Historically, they're not that related. For the last 5 years, it has traded that way. Frankly, I think it's more about animal spirits than the discount rate effect. I think the super low interest rates we saw for a long extended period helped create this bubble. So they are related in that way, even if you don't have a rational discounting reason for it. I think a lot of things got crazy.
All right.
Bottom line is I have no idea what's going to make it work. But over about 3 years, I'm pretty sure it will.
All right, down to our last two questions. All right, so we couldn't avoid this one. You talked about volatility laundering of private market strategies. What do you mean by that? And the second part of it, should investors look to the secondary market discounts to estimate true pricing?
All right, what do I mean by that? First, I'm just being a little nasty. Laundering is a loaded term, and I chose it intentionally to get attention. So let's just be. I left to start AQR. Partly I'd agreed, and I chose that to get attention. All right, there, fine. You got me to admit those things. This is a long-running thing for me. This has been going on. I've been fighting about this with people since at least 1997. 1997, I'm going to take you back in time again. We had something called the Asian debt crisis, where it originated in Asia, but like a lot of crises, kind of spread around the world. We had a down 7% day on the S&P 500. It was also after a very low vol period for a long while in the mid-90s. So this was a shocking day. John Corzine, who was then head of Goldman Sachs, comes by. We had been running our long-short portfolio that was a precursor for a lot of the things we do today for a couple, 2-3 years at that point. They had invested a lot with us, so I was one stop, and I'm sure he's stopping everywhere at Goldman saying, how bad is it? How bad is it? I'm going to waste all the rest. You don't have two questions. You have one, because I'm going on about this one.
We definitely have one more.
He looked at our screen. We were so shoestring in such a small team. We didn't sit by the real-time P&L all day. And I had shown John this screen in the past. So I walk out, and the head of Goldman Sachs is staring at my screen. And the screen says we're up 6%. We are not up 6%. I had to explain to John that what we were was short the U.S. and long Europe. And the U.S. was crashing in the afternoon when Europe was closed. It was my experience with being a non-mark-to-market manager. You get to look like a genius for a little bit. I told him we expect to be flat tomorrow. If you guess that European markets fall in line with whatever we thought their betas were with the U.S. The next day, and we thought we'd end up flat, which we thought was a home run. We had made money in a bull market, so it'll be flat. You can't take a man from 6% to flat and have him still think it's good news. It's very deflating. So then the head of Goldman's private equity comes by, and I learned my lesson by then. I'm manning the front of the machine. He says, how you guys doing? I go, we'll know for sure tomorrow, but we think we're about flat. And he looks at me, and he says, oh, us too. And I go, you're flat today? And he's like, yeah. I'm like, don't you really own a levered portfolio of equities? He's like, yeah. I go, if you went to sell them today versus yesterday, wouldn't they be down a lot? I mean, you wouldn't sell a private portfolio in a day. It's a theoretical. Even I wouldn't mark to market based on selling everything at one time. But to his credit, he said, oh, they'd be down a ton. But we don't have to sell them. And I'd be like, neither do I. I only have to sell them if somebody makes me sell them. I don't have to sell them. So I've been kind of having this fight, what you can observe and what is real. I'm not even sure which side is right. Private equity marking could be closer to reality than public markets. Public markets can go, perhaps are going too far, getting too depressed, too elated. But I do know it shouldn't really be any different. Either people should be very calm when public markets have losses and they shouldn't fire their value managers when value managers do poorly. One running joke I make is if we were private equity during these bubbles, take March of 2000 in the tech bubble, we were down a ton. The first product we started at AQR was a north of 20% vol market neutral fund. That turned out to be an error because we got about a 2 standard deviation negative a year and a half, so we were down about 36% out of the gate. We made triple digits back very quickly after that. You don't have to feel for us. But that's a near-death experience as a new firm. And I would tell people, I have to report down the 30, down the 35. I don't get to say, we've not lost you money. We are right. The market has overreacted. Your money is very safe in a place I call the bank of short NASDAQ. Such a bank does not exist, as you know. No, you have to say, this is what I'd get if I sold it today, and here's why you should stick with it or double up, because so I don't know why the deal is different. So admittedly, and in my piece in II, I say a fair amount of this is professional jealousy, that we have to live through this. Probably somewhere in the middle is closer to truth. Probably public markets do go too crazy, and people should be calmer about that. But the private markets know how to move things if they wanted to. These people are the best people at valuation in the world. If you said to them, markets fell 20%, what could you sell your portfolio in an orderly sale? I'm not talking about a panic. Now, and the secondary market may be a very good source for that. But even more generally, what could you sell your portfolio for now? They know how to do it. They don't want to do it, and nobody wants them to do it. So I admit that frustrates me a bit. So occasionally I write nasty pieces in Institutional Investor and then hide in Greenwich, Connecticut again. Every 20 years I need to hide.
We appreciate that you do that. All right, last question. As many of you know, Cliff is a big user of Twitter. So we looked through a couple of Cliff's tweets. And Leanna Orr...
Does this night end with me going to prison?
It does not. But no one makes...
Being canceled?
No cancel.
Okay.
I just don't think anyone is going to come to your dinner party.
I don't think I've said anything.
No one's going to come to your dinner party.
You're still allowed to make fun of private equity in this world. They're not a...
No, well, Leanna Orr, editor of The Allocator, called this the ultimate value play. So for anyone that can't see this, Leanna's...
It's a terrifying moment where you're like, what did I say?
So Cliff responded to a comment that said, what's 100% totally a scam, but we will accept it in a society.
It was a general question about not investing even.
Yeah, But Cliff decided to respond, and he said, expiration dates except on dairy. So my first question is...
throwing things out because they're like 3 days after the expiration date. They're fine.
Is there a model that helps you to predict that?
Yeah. Trust the dairy. I won't take a risk with that.
All right.
Soft cheeses. You want to really religiously follow those dates on.
And do you think that's the ultimate value play?
I don't know. I was just having fun with that.
All right, everyone. Let's give it up for Cliff. Cliff, thank you for coming tonight.
Yes, if you could somehow invest in a secondary market of expired goods.
Let's give it up for Andrew and Cliff one more time. I know you guys are all excited to go watch the young, talented Pacers beat those Bulls before the snowstorm comes in. But before that, I wanted to follow up on what makes a great organization, and being able to do all these events is not just the people involved on the board, but it's all of our sponsors. So thank all of our table sponsors here tonight, as well as our sustaining sponsors, Bloomberg, Harvard Capital Advisors, Invesco, Proteus, and Macquarie. We really appreciate you guys. You allow us to give discounted tickets to everyone here to fill the room like this and put on the events that we do here, the investment forum at the Speedway, and all the different things. I think we gave back $7,000 at our charity golf outing this year to a local financial literacy organization. So we really appreciate everything you're doing. And then those local firm, shameless plug for the local firm members, Vallejo Financial Advisors, where I work, Barnes & Thornburg, and Reams Asset Management. We really appreciate it. It's a network effect to do all this, so thank all of you.